The most dangerous mistake in macro right now is thinking the gold conversation is about sentiment or fear. It isn't. This is about arithmetic. The dollar system is hitting a zone where the math turns reflexive. Higher rates tighten funding, tighter funding breaks weak balance sheets, and the attempt to stabilize the break forces liquidity back into the system. Exactly the cycle that ultimately devalues the unit you're measuring everything in. That's why $5,000 gold is not a bubble thesis. It's an output. Roughly, by recent estimates, global debt sits in the hundreds of trillions of dollars, while interest expense, public and private, reprices far faster than politics can handle. When a system's liabilities are that large and the funding cost is volatile, you don't get a smooth adjustment. You get a sequence. And that sequence is not a mood. It's a mechanism you can see repeating across history. The claim sounds aggressive because it is. We are early, not because the move won't be violent, but because the full mechanism has not finished its last step. The pattern is mathematical. Start with the foundation. A reserve currency system is not just a flag in a central bank. It's plumbing. It's invoices, collateral, repo, cross-currency swaps, and the global habit of storing value in the liabilities of one government because those liabilities are liquid and accepted everywhere. The dollar became the world's accounting language, and for decades that language got reinforced by network effects. Trade settles in dollars. Commodities are priced in dollars. Credit is intermediated in dollars, and stress is solved with dollars. That foundation is stage one, even when nobody calls it that. It feels stable because it's everywhere, like oxygen. Then comes the expansion phase. The system works so well that it invites overextension. Credit creation expands to satisfy real growth, then expands to satisfy financial growth, then expands to satisfy political promises. The trick is always the same. Liabilities grow faster than real productive capacity, but the pain is delayed because the reserve currency can export stress. The world absorbs the paper because the world needs the paper for settlement. And because the world absorbs the paper, the issuer learns the wrong lesson. More paper is always possible. This is where the debasement doesn't have to look like a wheelbarrow of cash. It can look like rolling deficits, extending maturities, leaning on foreign demand, leaning on domestic banks, leaning on the funding market, and calling it normalization. It's still expansion of claims against the same underlying base. Then comes the crisis phase, the part everyone wants to skip. It arrives when the plumbing starts to reject the overextension. It shows up as funding stress and FX stress first, not as a neat headline inflation print. It shows up as widening cross-currency basis, as foreign central banks burning reserves, as money markets demanding more collateral and higher haircuts, as auction tails, as dealers choking on inventory, as volatility forcing risk managers to cut, as liquidity disappearing exactly when everyone wants it. The system loses control, not because the people in charge are stupid, but because they are trapped between two forms of failure. Tighten enough to defend the currency, and you break the debt structure. Ease enough to save the debt structure, and you undermine the currency. That is what loss of control looks like in a modern reserve system. It's not dramatic in one day. It's a series of forced trades. And then the inevitable outcome, the value anchor shifts. When the unit of account becomes unstable because its supply must expand to rescue the structure it financed, capital rotates to anchors that are not someone else's liability. In every cycle, the final step is a repricing of real assets, especially monetary metals, relative to the currency and to paper claims. This is why gold is different from a tech stock or a housing index. Gold is not a claim on cash flows. It's an alternative to the system's promises. And when the system's promises have to multiply to keep the system alive, gold doesn't need a narrative. It needs only the math. If you want to understand why this is still early, you have to stop watching gold as if it's a standalone trade and start watching the dollar machine, the funding markets, the sovereign auctions, the FX stress, the volatility. Because the dollar system is not a single thing. It's an interlocking set of feedback loops. When it's healthy, it looks boring. When it's stressed, it still looks boring. Just more expensive, more technical, more plumbing. And that's exactly why most people miss it until after the repricing. The repricing is never announced. It's implied by spreads, by swap lines, by collateral scarcity, by dealer balance sheet constraints, by sudden demand for physical delivery. This is also where silver enters the story because silver is both monetary and industrial. It's more volatile, more thinly warehoused, and more sensitive to liquidity whipsaws. When deflationary pressure hits, risk off, margin calls, funding costs rising, silver can get sold brutally because it trades like a high beta metal in the paper market. But when the system pivots back to liquidity, when the central bank, directly or indirectly, has to loosen conditions to stop the plumbing from seizing, silver's supply or demand mechanics can turn violent on the upside. The paper market can print liquidity as contracts. Physical markets cannot print inventory. That is the core tension that makes metals a stress valve. Paper can promise, physical must deliver. Now map the mechanism to history so you stop thinking this is a theory. 2 case studies are enough to prove the machine because they show the same sequence with different costumes. The first is the United States itself, from Bretton Woods to the Nixon shock in the 1970s. After World War II, the foundation was built explicitly. Bretton Woods created a dollar-centered system with fixed exchange rates, and the dollar was redeemable for gold at $35 an ounce for foreign official holders. That was stage 1 in pure form, a credible anchor and a network that made the dollar the settlement backbone. It worked because the US held a large share of the world's gold reserves and because the post-war era demanded a stable mechanism for trade and reconstruction. Then came stage 2, expansion and overextension, driven by policy choices and global realities. The US ran persistent balance of payments deficits as it financed overseas commitments and domestic programs. Dollars flowed abroad. Foreign central banks accumulated dollars. The world's demand for dollar liquidity grew, and the system's promise, gold convertibility, became harder to maintain as the outstanding claims grew relative to the gold stock. This wasn't conspiracy, it was arithmetic. When you promise convertibility at a fixed price while expanding liabilities, you create an imbalance that must be resolved by either shrinking liabilities or breaking the promise. Politics almost never chooses the painful option when the alternative is adjust the promise. Stage 3 arrived as crisis and loss of control, and it showed up exactly where it always shows up: confidence in the anchor and the funding structure that relies on it. By the late 1960s and early 1970s, foreign governments, France is often cited, but the pressure was broader, were increasingly unwilling to hold dollars indefinitely at the fixed gold price. The London Gold Pool, an earlier attempt to manage the gold price and defend the system, had already fractured in 1968 after speculative pressure. The US faced a choice: tighten brutally, crush domestic demand, and force a contraction of dollars to restore the gold backing, or end convertibility and preserve policy freedom. In August 1971, President Nixon chose the latter, suspending the dollar's convertibility into gold. That decision is often presented as a historical footnote. It was the system admitting that its stage 2 overextension had made stage 1 promises impossible. Then came stage 4, the inevitable outcome: currency devaluation relative to real anchors and a repricing of gold. The 1970s were not just inflation happened, they were the system's transition from a fixed anchor to a floating regime where the dollar's value had to be discovered through markets and managed through policy credibility. Bond yields rose, inflation became embedded, and volatility changed character because the anchor was gone. Gold didn't rise because people suddenly became superstitious. Gold rose because the currency lost its binding constraint. The repricing was the mechanism completing its final step. When the promise breaks, the alternative to the promise revalues. Even silver, which can be messy because it's more industrial, saw dramatic swings as inflation expectations and monetary credibility whipsawed. The point is not the exact path of prices. The point is the sequence. Foundation, expansion, crisis, outcome, same machine. The second case study is the United Kingdom in the post-war period leading into the 1967 devaluation of the pound, and the broader pattern of sterling's decline from reserve status. Britain entered the post-war era with sterling still carrying the prestige of an imperial trading system. That was stage 1, a network currency supported by institutions and history, but the foundation was weaker than it looked because the real economy had been strained by war, and the country faced chronic external deficits. The pound's role required credibility. Credibility required reserves and a capacity to defend the peg. Those requirements were increasingly mismatched to reality. Stage 2, expansion and overextension, came through the attempt to maintain living standards and global commitments while managing a constrained industrial base and recurring balance of payments pressure. Fixed exchange rate regimes have a cruel logic. If you run deficits, you bleed reserves. If you bleed reserves, you must either tighten domestic conditions to reduce imports and restore balance, or you must adjust the exchange rate. Britain repeatedly tried to defend the pound through policy tightening and international support, including assistance and negotiations with other governments and institutions. But the political constraints were intense. Tightening domestic policy in a fragile post-war economy is not a technical decision. It's a social and political gamble. Stage 3, crisis and loss of control, shows up as speculative pressure and forced policy responses. By the mid-1960s, sterling was under repeated attack. Markets sensed the mismatch between the peg and the fundamentals. Defending the currency demanded austerity-like measures. Failing to defend it meant admitting devaluation. In 1967, the British government devalued the pound from $2.80 to $2.40. Again, don't treat the number as trivia. Treat it as the mechanism completing its crisis step. When reserves and policy tolerance run out, the peg breaks. Stage 4, the inevitable outcome, was a repricing of Britain's external purchasing power and a shift in how capital viewed sterling. Once you devalue, you do not simply reset and return to pristine credibility. You move into a new regime where your currency is priced with a risk premium and your financial conditions are shaped by the market's memory of that break. Bond yields, capital flows, and domestic inflation dynamics adjust. The currency becomes a variable, not a promise. And when a currency becomes a variable under stress, real assets and alternative stores of value gain strategic importance. Gold's role in Britain's story is not just as a commodity, it's as a global anchor that becomes more valuable when national promises become less reliable. These two case studies matter because they show something most macro commentary refuses to say plainly. Reserve systems and currency regimes don't fail in one dramatic collapse. They fail by stages through the plumbing. They fail through the mismatch between promises and funding capacity. They fail through external pressure that forces internal choices. And the final outcome, real asset repricing and a higher gold price, is not a prediction pulled from the sky. It's the historical output of the mechanism. Now bring it back to the present without yet doing the full step-by-step application. That's next. The dollar system today is the deepest, most liquid structure on Earth. And that is precisely why the overextension is global. The world is not simply using the dollar. The world is structurally short dollars through dollar-denominated debt, trade settlement, and derivatives that require dollar collateral. That means dollar strength can be a wrecking ball. When funding markets tighten, the first shock isn't always domestic inflation. It's FX stress abroad, forced selling, and a scramble for dollar liquidity that transmits deflationary pressure into risk assets and into high beta trades. And then, because that deflationary shock threatens the entire scaffolding, banks, dealers, sovereign funding, corporate refinancing, the policy response tends to reintroduce liquidity, explicitly or implicitly. This is the trap. The same machine that produces dollar strength in the tightening phase produces dollar debasement in the rescue phase. That's the bridge to $5,000 gold. Gold doesn't need hyperinflation. It needs instability in the unit of account combined with a debt structure that cannot tolerate prolonged real rates that are too high. It needs volatility in funding markets and stress in FX that forces policy back toward liquidity. And it needs a widening gap between paper claims and physical reality when too many people decide they don't want exposure to promises anymore. They want delivery. Because here's the part retail never sees until it's late. The gold and silver prices on screens are largely formed in paper markets. Futures, forwards, unallocated accounts, where leverage and netting are the norm. In calm periods, paper and physical behave like the same thing. In stressed periods, the difference becomes the story. Physical markets talk in premiums, delivery times, refinery capacity, vault inventory, and bar availability. If inventory draws down and delivery demand rises, the paper price can lag the physical tightness until someone forces the convergence. By standing for delivery, by pulling metal out of the system, by refusing to roll, by demanding allocated bars rather than a claim. Silver, with thinner inventories and more industrial pull, can go from dead to impossible, faster than people expect, precisely because the paper market can create exposure far beyond what can be delivered quickly. Gold, with its deeper above-ground stock, moves differently, but its function as collateral and as a monetary asset makes it highly sensitive to shifts in confidence and liquidity conditions. This is why the question, is it a bubble, is almost childish at this stage. Bubbles are narratives chasing price. This is price chasing a structural repricing of the unit. The mechanism is already visible in the plumbing if you know where to look. And the reason we are still early is that the system has not yet been forced to confront the present-day version of its 1971 moment. The point where defending the currency, defending the funding structure, become mutually exclusive in practice, not just in speeches. In the next stage, the story stops being historical and starts being mechanical in real time. What happens when treasury supply meets weaker marginal demand, when auctions begin to tail, when dealers hit balance sheet limits, when repo becomes more sensitive, when cross-currency funding costs spike, and when the global scramble for dollars collides with the political impossibility of keeping conditions tight. That is when gold stops trading like a chart and starts trading like an escape valve built into the system, because it was always there for that purpose. That's the pivot point, when sovereign funding stops behaving like an invisible utility and starts behaving like a market with teeth. Before we touch the present, you need the last proof point, because if you don't internalize how FX stress and dollar funding stress fuse together under pressure, you'll misread everything that follows as random volatility instead of a sequence. Look at the Asian financial crisis, 1997 to 1998, and don't look at it like a history channel. Look at it like a plumbing diagram. For years, the foundation stage was simple. Many Asian economies ran de facto pegs or tightly managed exchange rates to the dollar, and global capital loved it. Stable FX meant stable returns. Dollar funding was cheap. Local growth looked unstoppable. Banks and corporates borrowed in dollars because the interest rate differential was attractive, because the peg made it feel safe, and because global lenders wanted dollar claims. That was the setup, a currency promise and a balance sheet structure built on the assumption that the promise would hold. Then the expansion stage did what it always does. Dollar liabilities grew faster than the real capacity to earn dollars. Current account deficits widened in pockets, credit boomed, and maturity mismatches spread. Short-term dollar funding backing long-term local assets. Property and equity prices inflated. The system became dependent on continuous rollover. It wasn't fraud, it was reflexive leverage. As long as the peg held and dollars were available, the structure looked stable. The crisis stage arrived when the market began to doubt the peg and the flow of dollars. In 1997, Thailand's defense of the baht became the focal point. Reserves were drawn down, speculative pressure intensified. The moment the peg breaks, or even when the market believes it might break, the entire balance sheet flips. A company that owed dollars but earned in local currency suddenly sees its liabilities explode in local terms. Funding markets freeze because lenders don't want FX risk. Domestic rates can spike as authorities try to defend the currency, which crushes local demand and asset prices. This is the loss of control. You can't simultaneously stabilize FX, stabilize funding, and stabilize growth when your liabilities are dollarized and your reserves are finite. Then the inevitable outcome, forced deleveraging and a violent repricing of risk, followed by a policy response that tries to restore liquidity and confidence, but only after the damage has clarified the hierarchy. Currencies devalue, corporates fail, banks get recapitalized or absorbed, and the cost of dollar funding becomes a central variable rather than an afterthought. The growth miracle doesn't vanish. It gets repriced through the exchange rate and the credit structure. The lesson is brutal and consistent. When the world runs on dollar liabilities, FX stress is not an external story. It is the balance sheet story. It is the mechanism. Now we apply that same mechanism today, step by step, in the order it actually hits markets, not the order people argue about on social media. Start with the foundation. The USD system is the settlement rail for global trade and the collateral language for global finance. Treasury bills are treated as cash-like collateral. Repo is the bloodstream. Dollar swaps and cross-currency basis are the pressure gauges. The world is structurally positioned around the idea that dollars can always be obtained at a reasonable price when needed, either through markets or through official backstops. That assumption is the foundation stage, even if nobody admits it out loud. Check. Then comes the expansion or overextension that hides inside normal policy and prudent balance sheets. The U.S. issues massive amounts of treasuries to fund deficits, and the global system absorbs them through banks, funds, foreign reserve managers, and leveraged relative value trades. At the same time, private credit, corporate refinancing, and sovereign rollovers outside the U.S. remain deeply linked to dollar conditions. This is where the overextension becomes visible in market microstructure. More duration risk must be absorbed, more collateral must be financed, more balance sheet must intermediate it. Dealers don't have infinite capacity, and bank regulation doesn't care about your macro thesis. The machine keeps expanding claims, and the system becomes more sensitive to small changes in yields and volatility because everything is financed, verified. Now the crisis-tosh loss of control phase begins exactly where it always begins, funding and FX. When yields rise and volatility rises, dollar liquidity becomes expensive. Cross-currency basis can move sharply, signaling that swapping local currency into dollars costs more than it should. Repo rates can spike around collateral scarcity, quarter ends, or risk events. Swap spreads can behave strangely as balance sheet constraints collide with hedging demand. And the basis trade, levered positions that exploit small price differences between cash treasuries and futures, becomes a hidden amplifier. When volatility jumps, margins rise, financing terms tighten, and levered players are forced to unwind. They sell what they can, not what they want. That's how the safest market in the world can suddenly feel illiquid, undeniable. Then the mechanism pushes into sovereign funding itself. Auctions, bid to cover, tails, and term premium. When the Treasury sells a new slug of duration into a nervous market, you watch whether demand is real or cosmetic. A strong bid to cover can mask weak composition if the marginal buyer is price insensitive only because they're hedged, levered, or forced. Tails matter because they reveal that buyers demanded a concession, higher yields, before absorbing supply. Term premium can reawaken when investors require compensation for inflation, uncertainty, fiscal uncertainty, and volatility. Real yields can rise when markets believe policy must stay restrictive, or when growth resilience forces repricing. But here's the trap. Rising real yields tighten financial conditions, which tightens funding, which destabilizes weak structures that relied on cheap financing. That destabilization then pressures policymakers and market plumbing toward a liquidity response. You can't separate auction mechanics from the eventual currency outcome because funding drives policy reaction. Check. Now bring in FX and global currency stress, because this is where the system transmits pain outward and then re-imports it. When the dollar strengthens into a tightening cycle, emerging market currencies weaken, dollar debt burdens rise in local terms, and central banks abroad face a choice: hike rates to defend the currency and risk growth, or let the currency slide and import inflation through commodities and trade. In developed markets, you see different versions of the same squeeze: Japan managing yield curves and FX expectations, Europe dealing with energy and growth sensitivities, everyone dealing with a world where USD funding is not free. The stronger the dollar, the more deflationary pressure gets exported through tighter global financial conditions, until something breaks and forces a pivot. Verified. That brings us to inflation, deflation transmission, which is the part people get wrong because they want one storyline. The mechanism is two-handed. In the squeeze, you get deflationary impulses. Risk assets drop, credit spreads widen, inventories get liquidated, demand cools, and commodity prices can fall. But if the squeeze threatens systemic stability, banks, funds, sovereign funding, or the payments chain, the response reintroduces liquidity. That liquidity doesn't have to be called QE to behave like it. It can be balance sheet relief, emergency facilities, swap lines, regulatory forbearance, or simply signaling that policy will not tolerate disorderly market function. Once the response phase begins, inflation can reassert through the currency channel through reaccelerating money growth or through a rising risk premium embedded in term premium. The system oscillates. Deflationary scare first, reflationary response second, undeniable. Now look at debt rollovers, because this is the slow motion engine under the drama. As maturities come due, refinancing happens at whatever the marginal price of money is, not at whatever politicians wish it to be. Higher coupons mean higher interest expense, which means more issuance, which means more supply, which means more reliance on stable demand, which means more vulnerability to volatility. Corporate debt and sovereign debt outside the US face the same logic, but with FX risk layered on top. When dollar funding is tight, rolling dollar debt becomes a solvency question, not a yield question. That's when credit events stop being isolated and start becoming correlated. Check. Now connect volatility to liquidity, because this is where the market feels possessed to people who don't understand plumbing. Volatility increases margin requirements. Higher margin requirements force deleveraging. Deleveraging forces selling. Selling pushes volatility higher. In rates markets, that feedback loop can be brutal because so much of the system is built on leveraged relative value, convexity hedging and duration hedging. In credit markets, widening spreads can freeze issuance, which pressures balance sheets, which pressures employment, which pressures growth. The central risk is not a single number like CPI. It's a regime where funding conditions can tighten faster than the economy can adjust, forcing the system to choose between stability of markets and stability of the currency. Verified. And now we arrive at precious metals. Not as a trade, but as the system's stress valves. In the paper market, gold and silver are often treated as liquid instruments that can be sold to raise cash during a squeeze. That's why you can see violent downside moves in silver, especially when funding tightens and risk assets wobble. But in the physical market, the picture is different. Refiners, mints, vaults, and fabricators deal with inventory, delivery schedules, and real scarcity. The paper price can move on positioning. Physical tightness moves on availability. When stress rises, you watch whether demand shifts from unallocated to allocated, from promises to bars. You watch delivery behavior, spreads between spot and futures, lease rates, and premiums and coins and small bars. You watch inventory drawdowns, how much metal is actually sitting in deliverable form versus eligible but not offered. You watch whether delivery requests rise at the same time that funding stress is rising, because that's when confidence migrates from paper to physical. Undeniable. Silver has its own torque, because supply-demand constraints are less forgiving. Industrial demand doesn't pause politely during a monetary panic, and mine supply doesn't respond on a dime. When the paper market sells off, physical can lag at first, then premiums can quietly rise because availability tightens. If inventories draw down while paper shorts rely on rolling contracts, the structure becomes vulnerable to a squeeze in the real world. Delivery pressure, higher premiums, and widening gaps between the screen price and what you can actually source in size. Gold is deeper and more globally liquid, but it has a different strategic role. It becomes the neutral collateral when trust in policy coherence erodes. When real yields whip around, when term premium rises, when FX stress forces policy concessions, gold doesn't need growth. It needs instability in the promise. Check. So here's the mechanism in the present in the precise order it tends to unfold. Dollar funding tightens, FX stress rises, deflationary pressure hits risk assets, volatility increases, sovereign funding becomes more expensive and more sensitive, and then the system reaches the point where disorderly conditions threaten core market function. At that moment, liquidity is reintroduced, overtly or covertly, because the alternative is a cascading failure through collateral and funding chains. And when liquidity returns into a world already saturated with debt and already sensitive to inflation risk, the currency absorbs the adjustment through devaluation and purchasing power. That's when gold and silver stop behaving like speculative toys and start behaving like thermometers for the credibility of the unit. Verified. This time is not different is not a slogan. It's a warning about incentives and constraints. American exceptionalism is not a hedge against arithmetic. Tech will save us is not a funding plan when auctions start requiring concessions and when the marginal buyer demands term premium. Modern optimism is not collateral at 8:30 a.m. when repo is tight, basis trades unwind, and dealers are full. The comfort stories are seductive because they're simple. The mechanism is terrifying because it's boring. If you want practical takeaways, stop watching headlines and start watching gauges. Watch the dollar's behavior against stressed currencies and against funding signals, not just against one clean pair. Watch cross-currency basis for signs that dollars are getting scarce. Watch repo conditions and short-term funding rates for spikes that reveal collateral stress. Watch treasury auction tails and bid to cover, but also watch who is buying and whether yields must rise to clear supply. Watch real yields and term premium as the market's verdict on policy credibility. Watch swap spreads as balance sheet constraints tighten or ease. Watch volatility, rates volatility especially, because it often front-runs forced deleveraging. Then watch metals the right way. Paper positioning versus physical signals, delivery demand, premiums, and inventory drawdowns. The goal is not to predict every tick. The goal is to avoid becoming the liquidity exit, the person who sells real assets into a funding squeeze, because they didn't respect the plumbing. If you're still here, keep following this series because the next piece is where we trace how the machine was built to behave this way, how policy, collateral, leverage, and global dollar dependency create a cycle that looks like random crises to most people, but is actually a repeatable sequence. And once you see the sequence, you stop asking whether $5,000 gold is a bubble and start asking a harder question. What does your portfolio look like when the unit of account is the variable and liquidity arrives only after it hurts? The verdict is calm because the mechanism is calm. Funding stress forces policy choices. Policy choices reshape currency value, and real anchors reprice when promises multiply. Are you positioned for the math or for the story?